many asset managers have published their research reports. I'm particularly interested in comparing research reports issued by European companies and also North American companies. You can always get different views, and in the meantime, you can get a more holistic picture. Today, I'm going to compare the 2025 Global Investment Outlook published by two firms, Amundi and Morgan Stanley. Let's see the common views shared by these two big boys. Number one is they both believed that AI will shake up everything in the world. AI will boost productivity in rich countries, and especially they both believe that AI will turbocharge Asia's tech hubs, especially India. But they remind us to be aware some companies like the US tech giants can get too much and too powerful. Europe is on the rise. Both firms love Europe's comeback story. Amundi said Europe's massive new defense and tech spending, especially Germany's 800 billion defense plan, will fix its slow growth problem. And Morgan Stanley said bet on German mid-sized companies. They will benefit from cheaper energy and fuel regulations. The third point is they both remind investors to be very diversified. Don't put all your eggs in one basket. Both firms said you should consider buying European and emerging market stocks because they are cheaper than US stocks. In the meantime, you can also consider adding private assets such as infrastructure or private equity into your portfolio to gain steady returns. So let's now move on to what they don't agree on about the perception of US stocks, whether it's a bubble or a boom. Amundi thinks that US stocks are pricey indeed, especially Magnificent 7. But you should ignore the hype. In the long term, they will be fine because AI will eventually keep them continue growing. But Morgan Stanley said there's a danger there. Tech stocks are already too concentrated. They make up about 30% of the S&P 500. If Fed raises rates and layoffs continue to surge, stocks could crash. How about bonds? Whether it's a safe haven or a sucker bet. Amundi said you should consider buying bonds. Higher interest rates means higher returns, especially in Europe and emerging markets. Morgan Stanley said you should consider sticking to short-term bonds and municipal debt. They pay higher than treasuries right now. But you should always avoid junk bonds. They are overpriced at the moment. So about emerging markets, Amundi love India in particular. India is the new tech superstar. So they expect 8% annual return to be earned from India. And Morgan Stanley said India is great, but don't write off emerging markets entirely. You can consider buying Brazil and Mexico. They will profit from higher commodity prices. And who is right and who is wrong? It all depends on your investment horizon. So Amundi is a long game player. They focus on 30 years trends like climate change, aging populations, and AI. So their advice goes like buy and hold solid assets such as infrastructure, global real estate. But Morgan Stanley is more a short-term player. They look at the next 12 to 18 months. So their advice goes like you should stay limbo, buy cash, short-term bonds, and assets that can benefit from volatility, such as gold or hedge funds. So here is the thought. You can think of Amundi as the patient investor. They encourage you to buy and hold for decades, while Morgan Stanley is a trader. They buy low, sell high, and dodge bullets. In 2025, actually, you will probably need both skills. Stay disciplined and stay alert. Thank you for watching. Again, this video is not for any investment recommendation or advices. It only reflects personal views only. Thank you.